Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Tuesday, July 21st, 2026. It is 10:11 a.m. Eastern Times. I'm starting the video, so we're about 40 minutes into the trading day. Here's what I'm going to cover in this order. It's going to be a bit of an eclectic mix. These are a few of the things I'm watching, not all inclusive, but I'm going to go through them in this order. And I'll kind of do just cursory updates because I've covered all of these in depth recently within the last week or so. I'm going to start out here with an update on Bitcoin and strategy. Those are still active trades, but kind of a little caveat asterisk to them. I'll go over that in a second. Then I'll go into just a brief update on GDX, gold, the US dollar, some of the currencies. I still, that's also a long trade, an active trade, actually, should say. The other one was a long term short trade. GDX and gold and silver long trades. Treasury bonds, we don't have a position, but I'm very much watching those and corporate bonds. So we're going to just a quick update on bonds. I want to point out something that the market doesn't seem to either care about or watch, doesn't seem to be watching right now. But again, I'll go over that in a second. And then a quick wrap up with where we're at on the financials and the VIX. Okay, so starting out in that order, this is IBIT. This is the one of the newer Bitcoin spot ETFs that were approved and started trading in the beginning of 2024. This one is just kind of the proxy I use, one of the most liquid. And as I had highlighted, we hit on both the spot Bitcoin. We hit a long-term price target that I had, a downside target. With positive divergences I've highlighted. And that divergence has played out. And we also broke above the downtrend line, the falling wedge. So on face value, and unless this fails, that's nothing but bullish. Now, I still maintain the longer term targets on strategy. That's our proxy trade for this. And I'm going to point out a potential trade idea here. So you remember strategy's fate obviously depends on Bitcoin. Strategy uses a leveraged model. It's a Bitcoin, the biggest Bitcoin treasury fund. So they hold Bitcoin. So obviously this is kind of saved the day. There's been a lot of almost a crescendo of bearish headlines, the demise of Bitcoin strategy. I'm sorry. Now that they've had to start selling Bitcoin to use their whole new finance that preferred shares, dividend paying. They were pricing those preferred shares down at like 80 something cents on the dollar. And so I view this, I have absolute certainty, no doubt in my mind. A lot of this is short covering, but again, it's a 110% bearish technical setup. Now, we're going to talk on that real quick, and I'm going to give you an update on the trade. We drop down to the 60-minute chart. And we can even toggle back to that daily chart I was on, turn off all the lines. Bitcoin, and it doesn't show it here because this is a spot ETF that started trading there, is in a long-term secular bull market. There's no arguing that. The intermediate term trend, Bitcoin peaked back last year about October or so, and is clearly in a intermediate term downtrend, right? That's the longer term, goes way to the left of the chart. Intermediate is up, clearly bearish, lower lows and lower highs. That defines a trend. And then the short-term trend is bullish. And again, that was telegraphed by the positive divergence. Then we had the breakout right there of the downtrend line. And then on the 60-minute chart, again, we're in a downtrend. These are, I know it's a busy chart. I have a lot of levels from before. But as you can see here, on the 60-minute trades very well. Bitcoin's it trades great to the technicals. Again, I'm not a believer in Bitcoin as far as what it is, just a bunch of bits and bytes, and people put a value on it and whatever. It doesn't matter. I trade it long, short. You guys know me. I don't care. Swing trading is not about fundamental analysis, or you don't care about the fundamentals. You're trading on the technicals, and so along the way, on the 60-minute chart, every now and then I give you, the developments, bounce targets. We hit 1, 2 there, or no, wait, I removed T2 right there, which we came close to it there. You can see it swings. You get these divergent lows. That was a divergent high right there. The drop, divergent low, rally, divergent high. So, and then sell signals, of course. Divergence in itself isn't a sell signal. But if you get a divergent high rally into resistance, that can often do the trick. This was a key support shelf right here. Why? Because you had a reaction low, another reaction low, then a big gap down, and once you gap below it, the bottom fell out. And so then that proved to be resistance up here. And so this is kind of that zigzag. So if you just take a step back, look at the intermediate term trend, we're in that downtrend with a short-term bullish uptrend. Short-term being this late June low, which I highlighted repeatedly is a divergent low, plus Bitcoin, spot Bitcoin at support. I'll get to that in a second. Now, where I'm going with this is that was also, we had a divergent low, went up a little bit, then corrected, went a little higher, corrected again, made a new low. So going off the current, analyzing off the intermediate term downtrend, Bitcoin's still in a downtrend, intermediate term, short term uptrend, but we're at pretty good resistance right now. I see a lot of reactions here, and most recently, I'll put the highest weighting on recent reaction high right there. So I'm going to say this is an objective short entry. There's no sell signals. It's strong. There's some short covering rally, but the volumes have been a little bit weak, and we have the negative divergence I like to see. So the bottom line is we're at resistance with negative divergence on a counter trend bounce. It's not the highest probability entry, but I think you can take a shot there with a relatively tight stop. Well, depends where you're targeting. I'll share my targets. We'll look at strategy in a second. Just wanted to point out that that's what you get in a downtrend. You're always going to have counter trend rallies, and I'm viewing this as that so far. Now, let's before we get to strategy, let me look at spot Bitcoin. Go over that with you. Okay, this is BTC. Crypto trades on the Paxos exchange. This is a long-term 5-year chart. So this is how we trade. These are the long-term trends. We were coming off a strong bull market there, ended with a divergent high, followed by a sell signal, gave us this downtrend. Again, that was back in middle of 2021. This bear market didn't trough out until early 2023. Had what I like to see, positive, aka bullish divergence, and triggered a buy signal in that trend line breakout coming off that divergent low. You can see my divergence lines. Nice clean uptrend. I had 2 uptrend lines, big divergent high, and this is where we started getting bearish and short. Breakdown 1, breakdown 2, back tested, and this is the level we've hit. And I've been covering Bitcoin quite actively recently. So we hit that 58,628, we'll call it 58,630 support / target with positive divergence. And again, that's you need to take note, because quite often a divergent low will mark the end, especially on this longer term daily chart, the end of a run. So again, caution is warranted on the short side, and that's why I'd keep stops relatively tight. It is a divergent low that I suspect will fail. Because if that's what happens, if this is early stage bear market action, which I believe it is, I still have these longer term targets. And so it's a matter of where does it fail. Remember, we already had a bounce once, and I had 2 trend lines here, and we bounced, hit one, got rejected. So we're still below this primary uptrend line right now. And that in itself indicates most likely a bear market rally. So I just want to point that out. And in fact, the last update I gave you on Bitcoin was just on Friday. I gave my weekly summary. It means I covered it earlier in that week. And right here, where is it? Somewhere in there. Aha, had to scroll down a little bit. All right. So as I threw out caution, we're took out summarized it there, but the bottom line is we have positive divergence still in place at the recent lows in both strategy and Bitcoin, and we need to see those lows taken out. And even better, I want to see the positive divergences that I just showed you, especially on the daily chart, taken out in order to sharply increase the downside, the odds at my next downside price targets on strategy and Bitcoin will be hit. So let's jump over to strategy again. It's the official trade, and there's a lot. It's a long-term chart. You can see it trades just like Bitcoin's, just going to be trading a multiple thereof. That was a divergent low. A lot of times this chart platform just takes my lines, makes them disappear. But most recently, put in this divergent high. We hit these two targets quick. We covered all shorts here on the site back in 2025. We went long, we put in another divergent high. I laid out 1, 2, 3 targets for you. We with perfect exit point right there on T3 hit. Then we bounced up here. Guys, there's so many targets, hard to keep track of. T1 zone. I had canceled T2 and 3 out of caution. When we hit this top of that first target zone, we booked full profits there on the trade. And it was a good thing because it gave back 2/3 of its run off the lows where we reversed and went long right here. And so we sidestepped what probably would have been a stop out on any reasonable trade. Sat tight, waited, and then started shorting it again here, here, and here. Give you multiple short entries. And that's it. So we hit the first target recently, took it out, undercut it with, remember, all that while Bitcoin, which is all that matters. It's the same thing as trading GDX. You want to watch gold. GDX just recently undercut a support level, but I don't care two flips about it. I'm still bullish and long GDX because gold's holding support. GDX will follow gold. Anytime there's a disconnect, if it's falling a lot more and gold breaks out, let's say, that's an opportunity because GDX will realize it's going to follow the leader. The leader is gold. Same thing with strategy. So that breakdown in strategy, although bearish on face value, we're back to, all we are is really back to, if you look where strategy is, it's only back to that previous low right now. So I want to point that out. Now, on the bullish front, we did take out the downtrend line right there. Positive divergence, but again, it's divergence that I'm betting on will fail. I still maintain these targets, but as I've stated in the last couple weeks, caution's warranted. And if nothing else, I've said stay away from that MSTZ, the leverage one, because we've been grinding around. This is consolidation. Let's not forget that strategy is down until the recent lows was down 85% off its all-time highs. So you're going to get some consolidation there. So again, by, in a vacuum, if I, had no biases, no long-term analysis on Bitcoin, we couldn't look at the weekly and monthly charts, know how the fundamentals are working and all the shenanigans that Saylor's been employing with this company, with the leverage and then the fancy dividend preferred shares now and all that other stuff. It really seems to me like this thing's jumped the shark. So I'd still maintain these targets. But again, this will be where the floodgates open up. If we take out the recent lows and we burn through these divergences, meaning take out the previous lows, that should be it. So I did just want to point out, we go down to the 60-minute chart. Let me mark it up. I've been tracking Bitcoin more closely because, again, Bitcoin rallies, it saves the day for strategy. Strategy really doesn't have a divergent low or anything like that. It did take out that little minor downtrend line there, but you can see I'm going to put up another resistance line. Again, I just showed you, here it is. So there was a previous major reaction low back in February. We took that out recently and we've been back testing it. So again, I'm going to reiterate, I think this is an objective, albeit somewhat aggressive, but an objective short entry or add-on on strategy with relatively tight stops. Whether it's you don't have a position, you're taking a new position, or you're in it long term and you're looking to add on the shares that you increase, because if it goes up much more, well, you're going to take out resistance as I just showed you on Bitcoin. And again, we'll go back to Bitcoin. IBIT you can use, or the Bitcoin chart, BTC that I gave you. Where to, this is my next resistance level on IBIT, about 40.13. So maybe a stop somewhat there. And as always, beta adjust, especially with strategy, beta adjust your position size. By that, I mean, take it down to a smaller size than you might normally trade elsewhere. All right, so let's move on. There's my update on that. Again, I'm not gung-ho about it, but I'm highlighting both an update to the existing trade and look, if you're seeing it the other way, guys, if you're bullish and long, this was again, I showed you positive divergence on the daily chart of both Bitcoin, of strategy, positive divergence here on the Bitcoin 60-minute chart, a breakout of the first downtrend line, second downtrend line. So if you're going the other way on this, And you're long, you can buy pullbacks to the support level. Oh, by the way, if you want to be the second mouse that gets the cheese, here's a little near-term uptrend line that would trigger a sell signal. So there's two ways for me to enter a short trade objectively, either on a bounce back to resistance or a break below support. And so just like right here, we had a counter trend rally, broke support, next leg down. Counter trend rally, broke support, next leg down right there. I didn't say I was going to get into the markets, and I didn't plan to, but I do want to make mention here that Bitcoin, for the most part, there was a while where it was a kind of a, and that's what the Bitcoin heads, the original crypto heads, said. It was a way to get away from the status quo, the rig system, the fiat currency system, and it kind of did its own thing irrespective of the stock market. And at times it even would rally when the stock market went down. But when Wall Street got their dirty claws into it and completely legitimized it via first futures contracts on the futures exchange with Bitcoin and Ethereum futures, then GBTC, which was then became, that was the precursor to an ETF, the spot ETF launches. Then the spot ETFs, it's all over the place. It's in pension funds now. It's in hedge funds. It's in, all over the place. And so that kind of, in my opinion, took away from what it was originally engineered for. Now it's just mostly a risk on asset. So where I'm going with that is QQQ, as I highlighted to you yesterday, QQQ broke this on the daily chart, broke the symmetrical triangle, and I highlighted objective short entry on the back test. We're still back testing it. So ideally, you want to see, number one, a rejection. Especially, you don't want to see a breakout of the downtrend line because that's going to be nothing but bullish near term. A breakout of the, if we go back into this triangle and then break above it, right? You've got kind of a whole confluence of recent trading right here. So that's going to help, unless it fails on face value. If it breaks out, that's bullish, and that's probably going to help Bitcoin because Bitcoin's been trading, as you can see, with, for the most part lately with the stock market. It's a risk on asset. And let's not forget the all-important T1 level. This QQQ is still an active short. We quickly hit my first target. The top of the first target zone. We perfectly hit that level again. So that very much defined that as a significant level. And as I maintain, we need to break that to trigger the next sell signal and sharply increase the odds we're going to hit my additional targets. If that happens, I do believe that it will be a net bearish for Bitcoin, and that will help that play out. So another takeaway there is, guys, there's not a lot of diversification, although Bitcoin is 110% by its nature non-related. It's not related to the NASDAQ 100. NASDAQ 100 is full of companies, all companies that are, the majority are very, and in some cases, massively profitable, have earnings, have tangible assets, intangible assets. Bitcoin's nothing. It's bits and bytes. And then there you have derivatives that are tracking it, derivatives being futures and ETFs and options and all that other crap. But so they're unrelated asset classes. Now, as I mentioned, they may be but they're correlated. So it doesn't matter. Just like some things are correlated to the price of crude oil or the U.S. dollar, like gold and the U.S. dollar, have an inverse correlation. They're not one and the same, but so hopefully that makes sense. Hopefully I didn't take you in the weeds there. Right now, like I said, I think the correlation is likely to remain positive between the stock market and Bitcoin. So the takeaway again is I'm trying to preach, proper asset allocation, diversification within a portfolio, even if it's a swing trading account, just as important as investing. Don't put all your eggs in one basket. And by that, it means if you have 20 individual positions, but your positions are NVIDIA, QQQ, Alphabet, SOXX, and IBIT, Bitcoin. Guess what? You have one position. You have no correlation, hardly any diversification. Those are extremely correlated assets. They're all either components of the NASDAQ 100 in the tech sector or, again, so take that into mind if you are trading both of those. All right, moving on to the next one. There's my update on it. So again, To reiterate, I think an objective, albeit somewhat aggressive, short entry or add-on on strategy, keeping stops tight, kind of betting on the fact, which is still my expectation, that this is just one last, hoorah off that support level. But again, if you want to be the second mouse that gets the cheese, then wait for QQQ to break that bottom of my support zone there and take out this positive divergence. So we only have it on the PPO right there, and then that should get things going there. Okay, next up, GDX. So GDX, I'm going to tweak this trend line ever so slightly. Why? Just to come in and capture that top of that candle there. And this is that little falling wedge I gave you the other day. I gave you targets here on the 60-minute chart, which I still very much maintain, like this one. And again, GDX, it's all about where gold goes. So this is GDX. We shorted that one like with gold and silver right off the highs. GDX, unlike gold and silver, made a marginal new high, but we went on to hit my first, second. I canceled T3 because that's when gold hit my final price target, gold and silver both. And so then give you off the initial bounce up there, I give you two targets, the downtrend line in this midpoint. Both of those were hit, and it's still an objective scale in, hard entry, depends on how you're trading it. This is gold GLD, identified and warned of the blow off top. Sell signal triggered on break of the uptrend line, parabolic top, first, second, third, and final target was hit. Potential is just that, only official if I eliminate the word potential. And so as I stated, that's it. Plus, as an added bonus, we had that uptrend line that came in there as well. So gold continues to hold support. It's been a dead money trade since I started highlighting it when it first dropped back to my third target zone right here at the top of the zone, the bottom. I still like it. It still has positive divergence, and it's one of my favorite trades right now. It's not, it's not doing much, but it either plays out or not. And like any trade, doesn't mean I'm going to put my whole account in there. And if it breaks support, I'll address that at the time. I already addressed a potential scenario for a little whipsaw move down through there. I know gold futures had a little punch through the other night. Let's look at that real quick. Yeah, it doesn't register much. It was a little overnight. I saw a little pressure down, but this is that 120-minute chart I have also given you recently of GC. These are gold futures. You have nice positive divergence. Continues to build. And we broke out of this little minor downtrend line I gave you recently with back testing. So go up here, get a reaction there, and then break out of there. And these are still your three near-term targets. Going to give you, if hit, again, that would be about a 24% rally, and still what I believe to be most likely a bear market rally. Not long before, but starting about 3 weeks or so, a few weeks to a month before gold, silver, everything peaked with that blow off top. This is for new subscribers. And if you need me, I'll reference you where that was. In several videos, I showed you several instances, typically or historically, when silver and gold have blow off tops, when they go parabolic. Once that parabolic trend breaks, it's the start of a bear market with three components: the initial crash, which we certainly got, biggest crash in silver in 50 years, followed by months, sometimes even up to a year of a big sideways consolidation, big grind. And so if I'm right on this 20-something% rally, and remember, you're going to have a lot more than that in silver and gold. GDX, I'm sorry, because they tend to go up in a multiple of gold. That would just be simply a bear market rally within. I'm sorry, yeah, call it that, a bear market rally. If we pop this, here's your downtrend line. In other words, gold can do this, and this, and this. If it goes that, then down here, then that's still the top, right? Unless we take that out. And look, guys, I'm not married to, and I've spoke to this many times, I'm not married to the fact just because historically once gold and silver go parabolic and break, they do that. The initial crash, sideways for a while. I'm open to all possibilities, but I'm always going to be positioned how I think something's going to trade today, tomorrow, next week, and next month, where it's going to be. or a few months from now, depending on the time horizon for my trade. But let me give you this. So that's it. There's not a lot else to add. Gold's at support. Keep it simple. And as I said, I'm willing to see them try to flush out one little quick move down. If we break the bottom of the support zone, which is about 361, that's not a buy signal by any means. It's technically a sell signal, but the divergence will still be in place if it happens anytime soon. And I think it'll be a flush out move. So you wait for recovery back above. And that means that bear trap, false breakdown, is what it is if you recover back above there. Okay, so I'm open to that. So stops should be, in my opinion, and again, this is just me, you do you, at least on a daily close, solid daily close down, somewhat below there, somewhat out of range, especially if the divergences are taken out, and or on a weekly closing basis. That helps you avoid those stop raids, they're called, when they cut you down and then turn around and reverse through once they blow out most of the weak-handed stop loss orders right there. Okay, now, as I often say, any analysis on gold is incomplete without analysis of the US dollar. So we'll look at that real quick. This is NYICDX. This is the ICE US dollar index. You can see we had this multi-month trading range defined by this resistance zone up top right here. And this is the multi-month range. We had a breakout. We hit my first target. When we did, we had negative divergence, so we pulled back. That was a divergent high. We've been riding on this trend line right here. I'm going to tweak it a bit. I'm just going to fit it. Why? I'll show you why. Because I didn't have this low touching that candle. I'm going to come in there, and that's it. So we pretty much had a little slight whipsaw. You know what? Not even, to be honest with you. Okay, why? Because this candle here, see this red candle? We closed right there at the top of that candle. Back on. That was an intraday move through to close back on. So that green candle, we closed on the trend line, above it, and we're above it. So none of those were breakdowns. If you trade on any time frame I trade on, all that matters, the most important thing is how you close the candle on that time frame. If I'm day trading on a 5-minute chart, it's how that 5-minute candle closes, or a 60-minute candle. On a weekly chart, it's how it closes 4 p.m. on Friday. So these were intraday moves, what we call stick saves. So we're riding up that trend line. Now it's a trend line that I think is likely to break. We can go back up. It can develop like this. This is my divergence line. We could certainly wedge a little higher first. If we do, we're going to just extend these divergences. These indicators are lagging to the point that we could have another thrust up in here, then go on to break down. Or we could turn around and break down right now because we already had, that was a divergent high. So that's my preferred scenario. And that would be dollar down. And dollar down is net bullish for gold. Again, net bullish, when anything is net bullish or net bearish or something, it doesn't guarantee that asset's going to go up. If it just means that this is not a debatable topic. It's not subjective. A falling dollar is net bullish for gold, at least if you're trading gold in US dollars, because it takes more dollars to buy an ounce of gold when the dollar weakens. And when the dollar strengthens, it takes fewer dollars to buy an ounce of gold. So a falling dollar, if you freeze supply and demand on gold, meaning equal number of buyers and sellers, will cause the price of gold to rise. That's why it's net bullish. Now, you can have periods where there's overwhelming demand, meaning buying, or overwhelming supply, meaning more sellers and buyers. But all right, so that's that. And then I even get a little more granular because the dollar index is not an index in a vacuum. The dollar index is the US dollar against other currencies. And so the dollar index is almost all euro. It's over half. Half of the dollar index is its calculation or its weighting against a euro, which has a 57.6% weighting in the dollar index. So for me to make a case, I want to make sure I can make on this chart, the euro US dollar pair, it means when this chart is rising, the euro is going up against the dollar. It means the dollar is falling against the euro. And so what I see here is let me borrow you, duplicate you. Oh, it goes down here, put it back. That was and is a divergent low, not just a divergent low, but a divergent low had support there. Not great support. So basically, you have, in a nutshell, the euro US dollar pair is wedging down in this bullish falling wedge. And it's no mere coincidence. This is a mirror inverse image of the dollar index I just showed you because of that weighting there, right? So that's it. So we could break out now. We could go down wedge out. There are no guarantees. I'm giving you my analysis, my expectation. This will break out, whether we have another thrust down first. Because if we do, it's just going to extend this divergence, my positive divergence that I'm drawing here. Then we break out. And that's when, if and when, again, if and when is in conditional, that's when we should see gold start to giddy up, and GDX and silver. And then finally, again, the dollar is, even though the euro is a big component, it is not the be all end all. You also have the yen as the second largest component in the US dollar index at a weighting of 13.6%. And so this one's different. You have the dollar first and the yen second. So therefore, when this chart's going up, the dollar's going up and the yen's falling, right? So what you can see here is helps confirm my analysis. You have a very, very nice, well-defined uptrend line right here. You have really from this point over, this divergence has been building right here. You have a series of 1, 2, 3 consecutive divergent highs, each of them having their own little correction. 1, 2, not this one, not yet, but it's been extending. It's just one big rising wedge pattern with a little minor trend line here. So when we break here, from my experience, it's not set in stone. You had 2 divergent highs there and then the drop, but usually it's that third time's a charm on a third consecutive divergent high. So if this breaks, that means the dollar's going to fall, the yen's going to rise. And then if this breaks, that's even going to be more bearish, meaning more downside in the dollar against the yen, which would then, again, help the case of gold. So that's it, guys. Gold's at support, positive divergence. It's GDX, silver. Again, you can just, GDX and silver just going to give you usually a multiple there of whatever gold does, but you can trade gold directly or do what you want. And if you take the other side of the trade, just note these levels and use them for your own analysis. But that was a divergent high, big drop. Divergent high, big drop. Divergent high, we could get a big drop. Okie doke. Moving on. Let's talk treasury bonds because nobody else seems to be talking about it. I don't know. I kind of live in a vacuum. I follow my news feeds, read a lot of articles. I don't turn the TV on hardly ever, financial media, unless it's a Fed meeting or a big earnings report or something. I'll pop the idiot box on, pop it up on my monitor, Bloomberg or CNBC, just to hear that. But for the life of me, I think I've said this every time we get down here. I said it recently here, and I'm going to say it again. I think this market is grossly ignoring or dismissing the potential risk in the treasury in the bond market in general. This is TLT. I know this is a busy chart. Let me just turn off all the lines for you. Remember, TLT is the long bond. It tracks the 30-year bond. They call it the 20-plus year treasury fund because they're not going to keep rolling every single day. When you buy a 30-year bond, now it has 29 years and 364 3 days left on it. They're not going to roll it out. They're going to keep expenses low, but they're targeting the long bond. And I'll show you the long bond return in a second. So we have basically, as I've highlighted, a triple top bottom, and you can just flip this thing upside down and look at the yield. This is the actual yield of the 30-year bond. And as I've mentioned, I've covered almost ad nauseum recently that when you turn off all the lines, we have major resistance here. We've hit that level 3 times and we're about to hit it again. If we break above them, we just spiked it, but I predicted that spike would get, they would come in with a full court press, the Treasury Department, Fed, anything they can do to kind of prevent this breakout. This breakout, if we pop this level, which I still think look, all I can tell you guys, whether I think it's going to happen or not, That is, again, that would be my opinion, subjective, and until unless it does, it hasn't happened yet. But let me turn back on the lines. So about right here, roughly 5162 on TYX. You just move the decimal. That means a 5.162 yield, so about 5.16% yield. And this breakout, again, will not just be a multi-year breakout. These are my year break lines: 2026, 2025, 2024, 2023. So we've been pushing that level, but as I've stated repeatedly, I'm going to toggle over to a monthly chart. And when I put a line up here or do this, which I've done many times, that takes the 30-year bond back to levels not seen. Most of you know, even if you weren't alive or trading at the time, we had the financial crisis right here. The market peaked in October of 07 right here, and the bear market went through March of 09. So that encompassed the financial crisis or the bear market that ensued right there. The only real two bear markets in recent history, and then the dot-com bubble. The Nasdaq 100 peaked in March of 2000 right here, and that bear market ended in 2002. So bottom line, if yields do break out, it's going to take the long bond to rates not seen exactly where they were right before the financial crisis, where they had ticked up to then, and right where they were back then in the dot-com bubble. And so, if nothing else, it's a psychological level, significant in that form. And it's also, again, if anybody that has a background in economics or finance, especially financial markets, understands the importance of interest rates. As I've stated many, many times over, it is not mere coincidence we're experiencing the greatest bull market in history, because we have the biggest secular bear market in history, which was a natural kind of falling rates since we had the hyperinflation back in the late 60s or into the 70s and all the way into the early 80s right there in 1981. That ended a secular bull market and rising rates. This was the catalyst. I don't think you'll find a well-versed economist or anyone who's versed in the financial markets going to argue that the great bull market that we've had since the early 80s is not a result of the falling interest rate environment. It's just, again, it's economics 101. You just take my word on it as a business major, former stockbroker, or do your own due diligence. And it's two reasons: lower the cost of capital spurs economic growth, obviously, and more so also the alternatives. And that's the big thing here. And by alternatives, what happens, this pushes people, as rates fall, it pushes both individuals and institutions out of safe haven treasuries. And again, this is something I can tell you from experience, because when I, after college in the mid 90s, I became a stockbroker, Merrill Lynch. Then I went over, after working at Merrill, I started working in for bank brokerage programs. One after another, regional banks would sell. These are super regional banks. They're wholly owned brokerage arms. So I sat down with a lot of, both retirees, folks with CDs maturing, as well as customers with bonds. And back at that time, I remember the going rate on CDs was about 7% on average, and I had treasury bonds coming due, folks coming in, bringing me, I remember one lady bringing in a 15% treasury bond that was maturing, U.S. treasury bond, was right around a 15% coupon yield. And so what happens when you can get that money? Both individuals, again, not everybody, most of you listen to my voice are risk takers. If you're swing trading, you have a higher degree of risk. You're probably not, in your golden final years of retirement. Maybe if you have a lot of money. Again, that's your thing. But I can tell you there's a shift, and it is gradual, but it does happen as rates go higher. More and more individuals will start locking into a 5, 6, 7, especially 8% or even over here, 4, 5, 6 guaranteed safe money investments. And you have my word that institutions will start to do it more and more. And that is, you have pension funds, insurance companies. They can't take huge risks. A lot of them are bound legally where they cannot take excessive risk, and they need to have most of their portfolio in fixed income investments. And those that do have the ability, they start looking at the valuation in the stock market and the downside risk potential. Yeah, we're in a bull market. AI is doing great with the markets, but they understand that that can change in a dime, and the downside risk potential, including a crash, is increasing. So all I'm going to tell you guys, I don't want to beat a dead horse here, but just know that technically we're on the verge of breaking out. And although I am certainly, smart enough to realize that we could do this, that anything's possible, right now, the risk of a breakdown in yields is not even on the table. When you look at where we are in proximity, again, I'm going to draw a line here, put my lines back up. At this point in time, we are, as I said back here, within spitting distance of breaking out to, again, not a new 52-week high, not a new 2, 3 year high, which it would be, but a new multi-decade high in yields. And if you don't think that's going to make the headlines or affect, the market, especially guys, if it's a sustained breakout. Again, as I acknowledged back here, I expected him to come in and Treasury try to foil that. We break that out. And remember, this isn't just the US. We've seen gilts, the UK gilts, the Japanese bonds, the 10, their 40-year bond, all recently punching out to new highs. And again, I just can't convey the importance if and again, it's also, guys, not a binary thing. Please understand that. What I mean by that, a little pop over that high doesn't mean the market then crashes. It's incremental. With every tick higher, and it's incremental in two ways: both price relative leveled on yields, the higher yields go, and the longer they remain elevated. All right. Because you have a massive amount. We have that corporate debt wall coming due. A lot of corporate debt that was financed back here, back when COVID hit. I have to roll back to a weekly chart. I've discussed this many times. I'm not the only one. Every corporation and just about every individual in the world that had long-term debt refinanced. Individuals took 2.5 to 3.5% mortgages. It's well documented. Corporations went into debt, except corporations, a lot of them don't, they have some will issue 30-year debt, but this is the average debt coming due. We're going to have that debt rolling over here that was taken out here, and here, and that's going to have an impact on corporate profits, including the AI bubble, the data centers and all that. A lot of that money, the financing there is also via private credit. Which also will, have to roll over. All right, let me get away from that. Let's just hopefully understand the importance there. Now, the 10-year matters as well. The 10-year's got a little more breathing room, but it's not far from breaking out. You can see this is TNX, the yield of the 10-year Treasury bond, and it's also getting very close to the top of its range. If you don't have access to those yields, you can watch IEF, that tracks a 10-year bond. I'm on a weekly chart here. So you can see this is the 10-year. Here's a trend line off. That's when we troughed. That was when the 10-year hit its multi-decade highs or multi-year highs right there back in 2023. The 10-year is looking a little better. It's not at risk, but we're starting to crack this uptrend line right now. And so watch these levels. And the 10-year matters more to individuals and corporations because that's closer to what the 30-year bond, believe it or not, 30-year bond tracks the 10-year Treasury instead of the 30-year bond. Now, the 30-year matters. Again, it's going to make headlines, and it's going to affect a lot of things, including the U.S.'s debt costs. But watch that level or these levels. And again, you can use TLT to track the long bond. And I go back to a daily chart. So I know, spent a lot of time on it. Again, because the risk is we're again within spitting distance. We're in a just literally a bad day or two. By a bad day or two, what I mean by that, here's a bad day in treasuries. If you go like this, when I say a bad day, I'm just saying how much treasuries can move. There was a 1 day drop right there of about 1.18% from the previous close. Well, actually, might have been a little more than that. Yeah, that was yeah, close to it. We'll call it north of one about 1.3% yield. A drop in the percentage terms. So that would do it. If we drop that much in a day, it would break us out. And then if that breakout gets built upon, that's it, guys. Now markets seem to be shrugging it off, and that's fine. I've done this long enough to know that one of my many yogiisms, it doesn't matter until it does, right? And that has to do with anything, whether it's a bullish development going on in a stock or a commodity or security or a bearish development. As I like to say, it doesn't matter until it does. The market will often ignore positive or negative fundamental developments. And then all of a sudden, it starts to recognize it. Sometimes it's gradual, and sometimes there's a flashpoint. So I just wanted to impress upon that. I'm also very much watching investment grade bonds as well. This is LQD. Now, LQD, which is the investment grade, it's probably the biggest. It's the one I use to track the investment grade bonds. Those are the ones with credit high, investment grade credit ratings. Right now, you have positive divergence. So I will say this one looks like it, if it can rally off there, but it's just taken out support. It had divergence here, it rallied, kind of like Bitcoin too, as I'm showing you. It's rallied, but it keeps going lower. Now, it could play out, and this is important as well. Very important, don't get me wrong. This is, if this starts to go down, so watch this one. Here's your previous spike lows right there. That means corporate yields or the cost of borrowing for corporations is going up. Remember, they're not issuing at the same rate the US government is. Uh, but this is something to keep an eye on. And guys, if it goes the other way, if this rallies and we start rallying off the divergent lows, here's a nice resistance level. This is 109.74 on LQD. I'll set a price alert here. If we break above there, that means corporate yields or the cost of borrowing for corporations is going down. It means LQD is rallying. The price of investment grade corporate bonds is going up. So I set a price alert there to let me know. However, if we go down, especially if this divergence is taken out, then that's bearish. And one more thing to note on this chart. So we have positive divergence, just like we had positive divergence there. And it was good for a little bit of a rally, but then it kept the downtrend going. You notice how I have that purple level, my zero line marked. I've been sharing this quite a bit recently because we've had some trend indicators flip. Generally, when the PPO signal line, the white line, the 9 EMA is below, the trend is, as I'll show you here, bearish, right? When it's above, you cross above, like you did there, you have a bullish trend. Crossed above right here, you had a bullish trend. Crossed below right here, you had a bearish trend. We're below it, and we've had one whipsaw above, but you keep getting rejected. Zero lines getting rejected. So that tells me that take this positive divergence with a grain of salt, because the larger, or at least the intermediate trend, as defined by both lower lows and lower highs, as well as this trend indicator, is bearish. So I'm watching the credit markets, as I do, very closely. I watch credit spreads, and these are some of the things I'm watching. So again, I'm saying this it's something to watch. And also, if you're frustrated, like I said, the QQQ has been a dead money trade. So if you're frustrated because you have all your money in a QQQ long or short, you're going nowhere. You're trading today exactly where you were over 2 months ago, as I've gone over many times, but we're at the lower end of the range. And just like treasuries, especially the 30-year bond, are within spitting distance or a bad day or two of breaking out to new highs. If you look at where QQQ is, the risk on, the tech index, everything that matters right now. So it means we are just a bad day away from breaking that support. Remember, the bottom of T1 I already covered. By that, I mean, if I put my crosshairs where we're trading right now, you see this little candle right here. Oops, I didn't mean to move my trend line. I meant to grab the candle right there. I'll go next to it. We are exactly 2.76%. Market can easily drop 3% in a day, especially QQQ. So we're 2.3% away from that level. So you've got to go down below it. 3% would do the trick. To break to new highs, we'd have to go up over 6.5% or more. Okay, so again, the risk right now of a breakdown in QQQ is on the table and present on one bad day. The risk of a breakout, we could break out, but it's going to take a few days to get up there. You're not going to go up right now 7% in a single day. Okay, so just wanted to kind of put that in perspective where we're at. Again, objective short entry, just like I highlighted yesterday on the back test of this bottom of the triangle pattern, whether it works out or not. Also, the 50-day moving average. You can see if I turn off all the lines here. In an uptrend, the 50-day acts as support. Once it's broken, it tends to act as resistance. Here's a good example. We were riding it up. One little whipsaw there, but it did a good job of saying, bull trend. This is mostly a sideways trend. Lost it here. Rejected, 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 rejected. Gapped above it, never looked back. Tested, bought it perfectly. Almost hit it there. Perfect tag there and there. That's a 60-minute candle close on it. Daily chart. Hit it and then bounced off it. Closed right on it there. Lost it there. So that makes this not just one, but two resistance levels. The 50-day exponential moving average, which does a good job at defining the near-term or intermediate-term trend on the daily chart, as well as that triangle pattern that I showed you there. And I know how it works. I've done this a long time, especially for new traders. Most people want to buy on a day like today when the Nasdaq's up 1.45%. To me, I take that as an objective time. Again, if I had any short exposure I wanted to add, which I did this morning, I'll be honest, I did a little yesterday, a little today. I'm just scaling down. I'm keeping things light on the Qs right now until we take out the recent lows. Then I'll be hitting it pretty hard. But it's just like, it's like the big screen TV you're eyeing at Best Buy, that $2,000 85-inch TV. Do you want to buy it at the regular $2,000 price, or you want to wait for Black Friday when it's selling for $1,300? Buy it on sale. When you're short selling, you want to short when prices are up, not when they're down. You want to, you're getting a better entry point. It's the opposite of buying a pullback or buying a dip when you're bullish and you want to buy something on a pullback. The bigger the dip, the better the price is. And again, manage your stops accordingly. I already went over that earlier. Above that triangle would be certainly one place if you wanted a tight stop on this trade. But again, I've shared my thoughts on this. Let's move on to the next and last two, which are XLF, the financials. As I mentioned recently, we had a bearish rising wedge. I've been waiting for this and talking about this for weeks and months, saying, especially in regards to the stock market and the VIX. And I'm doing those weekly summaries. You can get it in there. I'd say it every week. The market won't break until the financials break. Tech is by far the largest. It's the largest sector of the S&P 500 at over about a third of the weighting of all 11 sectors. But financials are number two, and they also have a big psychological importance to the economy. And finally, we got a sell signal. We had a previous all-time high. We had a few attempts at breaking out that failed. And then we triggered a sell signal on the break of my bearish rising wedge right here. We did that yesterday, and we have follow through today. We're down below it. So that puts the XLF on a sell signal. It gives an objective short entry. If you want price targets, let me know. I'll be glad to sharpen my pencil. I can tell you the first reaction, the first pullback is going to be around bounce about 54.92, give or take. But more so, I'm looking to see, this continue down. It's my expectation, not just based on that little wedge there. This is my weekly chart. Big, big, big divergence, as I've covered before. Divergence not seen the scope of this divergence, meaning how long it's been building. This is multi-year, about 2-year divergence, only comparable in recent years to the divergence leading up to the COVID drop right there. And again, so I've said it many times over, COVID, and it will go down in the history books as a black swan event, but by every metric that we had at the time, a correction or a bear market was priced into the markets based on these same technicals, just like back here. We've had 3 bear markets in the financials in recent years. This one here, and I'll measure it out for you, the 2022 bear market, and well, I'm sorry, we haven't had this one yet. We had one right here, right there, divergent high. These are all my divergent highs, remember. This is just to measure it out. That 27% drop, the initial divergent high there was 27 also, but the divergence extended. It was larger, and then you had a 44% drop. Then you had a divergent high here with the 2022 bear market, 29% drop, and now you have divergence here. So again, whether we go a little higher first, extend the divergence or not, you want to see this trend line break. That's a key uptrend line that will trigger deeper targets there. But more importantly, again, I just wanted to reiterate that we do have the breakdown there, that minor trend line right there. And next sell signal coming to break that 54.92 support. Then this is what I call a potential uptrend line. This one may get tweaked because it's only 2 reaction points. In my book, I like to see a third confirming reaction to validate a trend line. So either way, so I'm watching this price support right here. It's a first target and potential sell signal there. Okay, and that brings us last but not least. So with the financials now, at least giving a preliminary sell signal, one on that. The VIX is still setting up, and so if this is a big if, again, there's other variables involved, but the 3 big things I'm watching now: treasuries continue to climb, especially if the 30-year breaks out, the 10-year, also the yield on the 10-year continues to rise. That should put pressure on the markets. If QQQ gets rejected off the triangle pattern, I showed you that it's back testing, but more so, especially if it breaks the recent lows, which is that T1 top, the first target on the 60-minute chart I gave you, and the financials continue down lower to that target I gave you there, especially if they break it, then the VIX will likely rock and roll. The VIX has this downtrend line right here. It's been building divergence. Again, it's not as if the divergence doesn't matter, doesn't work. That first divergent low right here resulted in a rally, just measuring using the measuring tool, 53% roughly from that divergent low to that quick pop. This divergence is an extension of the previous divergence there. You can see it keeps getting larger, therefore indicating an even larger potential rally. And so once we break out of the trend line, you get green light check marks if that happens, and QQQ breaks T1 check mark, and XLF breaks the aforementioned support levels there. And then this guy should rock and roll. Otherwise, as I like to say, just like on QQQ, support is support until unless broken. So far, T1's held support, and resistance is resistance until unless taken out. So we're at resistance on the VIX. That's it. So those are the kind of main things I'm watching, and they are all, like I said, interrelated. Most likely, if the stock market's going to continue to go up, if QQQ is going to go on and break out the new highs, as I've been stating before, it will change, the near-term outlook, but not my longer term. You had a divergent high here when we shorted right there on the break of this uptrend line. This is the active short trade. Hit our first price target here, bounce. Should we pop the triangle, it's going to sharply increase the odds that we go and we'll test and break and make a marginal new high. But as I've highlighted with these yellow arrows, if it happens anytime soon, within the next couple weeks, it is guaranteed to be a divergent high, a bigger divergence, because of the way the indicators are lagging. So Again, you'll have to trade that accordingly. There's no guarantee that if we pop it, it will only be a marginal high followed by a failure. It is my expectation. It is my what I call my alternative scenario based on the daily time frame. My primary scenario is we get rejected here, either on the back test of this minor trend line, or if we happen to pop up, you still have the downtrend off the highs. A lot of traders will focus on the downtrend lines off the highs. So this is kind of a bounce target zone. That's my preferred scenario, and that's still my final target, something like this. And this is my alternative scenario, but it's going to the same spot. It's just, if we do that, a marginal new high is only going to take you back to slightly underwater from our initial entry right there. Again, if it's marginal, that's where you can have stops somewhat above. Again, what's somewhat? It's relative to your target. If you shorted the break of the trend line and you're targeting my T4 on the 60-minute chart, the final target, that's about a 15% drop. So you could easily give yourself a 5% stop loss above the or your entry point, and that's a very attractive 3-to-1 risk reward ratio. You're risking $1 or 5% to make 15. But if you were only targeting T1, you took profits there, well, it's a whole different trade for you. Or if you're scaling in, so that's it. All right, let me wrap it up here. And that's it. So gold stands out as attractive. Bitcoin, I'm wanting to see a rejection, especially break of the recent lows. I highlight an objective but aggressive short entry or add-on or re-entry on MSTR or Bitcoin if you want to do those. And then again, levels to watch on treasuries. I have no position in treasuries. To me, it's more of something to watch right now, especially because the impact it may have on the stock market. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.